I've got two other videos on portfolio management or calculating expected returns from a portfolio that are a bit simpler than this. If you haven't seen it, please watch them. They're either linked in the description below or they're in the investment mathematics playlist. So let's first start deciding out our terms. So we're going to have ERA and ERB, which you should be fairly familiar with. So that's going to be the expected return of asset A or B, dependent on A or B there. And then you're going to have here, which is sigma B and sigma A, which is going to be the standard deviation. I'm just going to put a little asterisk here. So asset A or asset B. So standard deviation of asset A or asset B. We've got a little reverse fish going on here. So that is the weight of asset A. And then obviously when you're looking at 1 minus reverse fish, that's then going to be the weight of asset B. So if you've got two assets and you've placed 70% into one and 30% in the other, and that makes up your entire portfolio, this would be 0.7, and then 1 minus reverse fish would be 0.3, which would be the weight of asset B. So let's now create our ridiculous formula for calculating this. So it's going to be ERP minus sigma P squared, which would be reverse fish ERA plus 1 minus reverse fish. So that's the weight of A, the weight of B, ERB. And let's do that minus reverse fish squared, the standard deviation of asset A squared, minus 1 minus reverse fish squared, and then the standard deviation squared. So if you pay attention carefully, you can see that this is the weight of asset A multiplied by the expected return of asset A plus the weight of B multiplied by the rate of expected return of B. Then this is the weight of asset A multiplied by the standard deviation of A, and then the same for B. And then these are added together and they are subtracted from the difference of the standard deviations between both assets. So let's now give some values. So I'm going to say ERA can be 10%. Let's do the expected return rate of B to be, let's say, 6%. Let's do the standard deviation of A to be 15%, standard deviation of B to be 8%. And then we're going to make this 0.7. So you've put 70% of your money into asset A and 30% into asset B. So if you now plug this all in, you're going to get ERP minus sigma P squared, which is going to be 0.7 times 0.1 plus 0.3 times 0.06 minus 0.07 squared times 0.15 squared minus 0.3 squared multiplied by 0.08 squared. And if we now simplify that all, that's going to be 0.0764 times 100, which would convert the answer from a decimal back into a percentage. So it's going to be 7.64%. So the expected rate of return minus the portfolio standard deviation squared would equal this. So what does this mean? It means that the risk-adjusted return of 7.64% reflects how the expected return is reduced by the portfolio's total variance. It's a way to assess whether the return compensates for the risk, and it's best for optimizing portfolios or comparing strategies. So a slightly complex formula, but when you sometimes look at it in words and you think about what's actually happening to each asset, it's quite easy to understand. And obviously, if you've got multiple assets and you can calculate the standard deviation and expected return on each one of them, you can just add this along and you can add each term into this formula. I do have other videos on calculating how to calculate an expected return of an asset, so you can kind of predict the future or trend of what your investment will get back. And I have other videos on calculating the standard deviation of a particular stock or asset.